According to a recent article by The Motley Fool, JCP is amongst the most hotly debated stocks on Wall Street, but the reality is it shouldn't be. JCP is fundamentally headed for destruction simply because they continue to ignore what ails them the most: cost structure. The bull case, however, will point to two factors, one technical and one fundamental. Let's address both of them right now. If you pull up a chart of JCP from January 2012 until now, you will see what appears to be a bullish falling wedge formation, which in legitimate cases will often result in a breakout move to the upside. Will such a fate occur for JCP? I don't think so. When you pull up a longer term chart, the bottom of the wedge is essentially parallel with the bottom of the financial crisis. And according to the diagrams provided by the godfather of technical analysis, John J. Murphy, this would not appear to be a legitimately bullish formation. However, I don't rule out the possibility of a higher price swing from here. We can easily see a breakout move, but ultimately I believe this will be a head fake because of JCP's fundamentally poor cost structure. In stating the bull case, Dan Moskowitz, the author of the Motley Fool article, wrote, comps increased 470 basis points sequentially and overall sales improved in each month of the second quarter. JCP expects this trend to continue in the second half. Therefore, it's possible that CEO Mike Ullman's fixes are in motion. This is a deceiving sentiment that Wall Street prognosticators would like you to believe. It's clear as daylight, according to their financial statements, that JCP is staying afloat by simply performing the dreaded revenue for margin swap. This is financially an untenable situation because JCP can't print their own money and margin is a derivative of revenue. I know that they're doing this because their rate of change in revenue cost spreads over the last 4 quarterly statements are virtually at parity, or 98.4% to be specific. Parity in rate of change is good only when your financials are net positive. In this case, they are net negative, which means that the comp increase of 470 basis points increased in linearity along with everything else. What I mean is the scope of the situation has changed, not the situation itself. And that will ultimately be the doom of JCP unless management specifically addresses this issue. A rate of change ratio of 98.4% is indicative of how far behind management is, and unless there's a compelling reason to think otherwise, JCP is amongst the worst of the bear cases.